Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it. It's generally related to three different topics: wealth building, commodities, and/or financial topics. We're going to dive right in, take a look, and see what people are sharing. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com. I dive deeper into all of these different sectors and topics and areas, looking for potential investment opportunities. I do screen a lot of these companies through fundamental analysis, quarterly earnings calls. I listen to all these things and read their presentations on their websites, etc., etc. So there's a good high bar for companies to pass for me to share them with the subscribers. Black Friday is the coupon code that is active at this time if you would like to join and get some further savings. So Christine Guerrero says, fun with numbers today. If the average Indian had the same energy access as the average Indonesian, India would consume 2.7 million barrels per day more oil, and they would still have less than half the energy consumption of the average Chinese and 1/10 the consumption of the average US citizen. So they have a long way to go higher in energy consumption to just hit the average of some of these countries that don't nearly consume anything close to first world countries. So we have a ton of energy demand out there that could potentially be lit up over the next decade or so. Douglas A. Boneparth says, I face more peer pressure in my life to buy crypto than do drugs. I actually would probably say the same. I don't know why everybody's trying to get everybody to buy crypto so bad. You know, when you have a really good product, I'm talking about a really good product. There are a lot of companies that don't even do any advertising, and it's all done by things or people. They may see the car in person if it's a car or something like that, like Lamborghini or Ferrari. Um, how many ads do you see of that? And what they'll say is, well, we don't market to those people. Crypto's trying to get everybody on board. It seems like. Haynesville rigs, they fall 2 to 30, which is a new cycle low for Haynesville rigs, and that's natural gas mainly. And you can see that we've been falling ever since late 2023, the entire time as we pull back on natural gas production. And we're going to probably see higher natural gas prices. And when we see those higher prices, we'll probably see the rig count level off or maybe even go higher. I do understand that we are drilling a lot more horizontal wells with a lot more footage, lateral footage. So they're drilling these things many miles now, multiple miles. And I think they're trying to get them up 4 or 5 miles even, because the efficiency per drilled well goes up. You get more out of it. So that's what they've been doing to gain efficiency as they're drilling longer laterals and maybe even different ways or techniques of drilling that are kind of like spidering outward, which is kind of cool. And they're also doing these U-shaped ones too. Revisiting our bull natural gas thesis write-up and update. So at some point over the coming years, the U.S. natural gas market is going to break. The structural demand increase coupled with the stagnant natural gas storage capacity only means that the market will have to force liquefied natural gas exports to shut in. And that's if we don't have large enough inventory levels, because the fluctuations and the days of coverage is going to get really weird here. And I think it's going to cause large spikes in natural gas prices in both directions. It's probably a trader's dream because as inventories go up, you're trying to more accurately match supply and demand. The problem is, as demand grows and as your supply grows, if your inventory doesn't grow with it, you have to be more and more precise between demand and supply. But how can the drillers, which take a good, it takes some months to get everything kind of ramped up and ramped down. How are they going to know and how are they going to predict the weather? Weather is still a really big draw on natural gas inventories. So I don't know how they're going to balance this all out. It's going to get really difficult. And what he's saying is at some point over the coming years, the US natural gas market is going to break the structural demand increase coupled with the stagnant natural gas storage capacity only means that the market will have to force LNG gas exports to shut in. They're trying to get too precise between demand and supply. We need more storage capacity of natural gas and more days of coverage as the demand continues to increase. Agricultural commodities are hitting 10-year highs today, standing nearly 18% above their previous peak during the onset of the Ukraine war. So it looks like we could be setting 10-year highs here in agricultural commodities. And you know what's going to follow next? Fertilizers. Fertilizers generally follow the price highs here. So when prices go up, they try to produce more, and that generally means more fertilizers and stuff like that. They generally make more money too when commodity prices go up, agricultural commodities specifically. Come down. Brian says Peter Lynch returned 29% annually between 77 and 1990, turning $10,000 into 260,000. So every 10 turns into 260. During that amazing run, his fund dropped 10% 15 times, 15% 6 times, 20% 4 times, and 35% 1 time, and was below its recent high more than 50% of the time. Volatility is normal, is what he's trying to say. These stocks, I think, will beat Peter Lynch in a shorter time frame. The thing that you have to deal with is volatility. You're going to just as many of these pullbacks or more and greater than 35% over that time frame if you're going to try to do it in a shorter time frame. Myself, I actually did this with a few stocks already over a 2 or 3 year period. So I averaged 29% annually here. I did it a couple companies. I turned more than 10K into more than 260 in 2.5, 3 year period. And I still hold on to those. I'm hoping I can do 100 bag them. And that's where your asymmetry comes into play. That's where in years. That's what I mean by decades can happen in years. You can get, if you can buy when there's fear in the market and you buy something that is completely mispriced in a commodity that is way undervalued, those are the returns that you can potentially get. Right now, we can see that oil is incredibly cheap to gold, incredibly cheap. We're talking like the second cheapest time it's ever been in history. That's the type of setup where you can find these ridiculous returns. Natural gas is there too. And there's a lot of companies that I am looking at that I share with everyone on the website to find those types of returns that can happen far quicker than this. But the volatility can be, it is a lot. It's not an easy ride. Inverse Kramer. So Jim Cramer, all I can tell you is own Bitcoin. That's a winner. It's over. It's so true though. This guy, he creates exit. He tells retail to go buy a bunch of crap, and he basically gives them an exit to his buddies. It's exit volume. Brian says bear markets transfer wealth from short-term pessimists to long-term optimists. That's actually pretty true. I like that quote. That's pretty much nuts on there. Eric says maybe they pumped Bitcoin to maximum to distract the sheep of what gold and commodities are about to do next. I don't know if that's true or not. What I think is going on is that commodities are still coming out of their big bottoms. Oil is just coming out of it. We're going to go into a 5 to 10 year bull market in commodities. And I think that we're at the tail end of a NASDAQ, S&P kind of boom. And I don't think it's ended yet. I think what's occurred is that 2020 has sent maybe perhaps some weird signals. And those weird signals deal with the stimulus that came into the system. And I still think the stimulus overhang and all that stuff, it's there. And I think what occurred is it occurred in the middle, COVID did, in the middle of the boom of NASDAQ and all that stuff. I don't think we've legitly gone into an expansion phase. I think we're still at the tail end of a recovery phase, maybe even a mid-cycle wobble, perhaps not. And then we go into an expansion phase, which looking at housing starts, we're like right at that expansion phase. We're like mid-cycle wobbling on top of it. And then if they lower interest rates, that's when you're boom. You're going to get a weaker dollar and you're going to get more liquidity. And then gold and commodities are going to rip. If they do that, if they continue to leave rates drifting higher like they are, we could also see a rotation of money out of stocks if rates get high enough. If it's ideal business, the ideal business is one that earns very high returns on capital and that keeps using lots of capital at those high returns. That becomes a compounding machine, says Warren Buffett. And that is true. The difficult part is people can find ideas. They can get very high returns on some capital, but they can't do it consistently with an unlimited amount of capital. So they run out of ideas. They run an idea, they update a product, they get it out there, but then you can't continue to dump capital back into the business and come up with new ideas that work and give you those returns on a consistent basis. You can do that with something that is boring, that stays the same, but you just basically leverage it to the entire world. So things like insurance, things like soda or pop. I say pop. A lot of people say soda. But if you're a small company, you can continue to pile in and expand the business, and what you sell doesn't change. Other things where they go through cycles like cars or games like a PlayStation 1, 2, 3, 4, 5, like they continue to progress them, but that's your pipeline of products. In my opinion, and what I've seen, it's easier to grow a company that's just growing volume so they can pile back capital with a steady business plan where their things don't change. And those seem to continue to grow and grow and grow. I think the ones with a product can grow faster, but they can also die faster. So they grow real quickly if it's a very light capital growth business, like let's say like software or something like that. But they can also go in the opposite direction very quickly too. Investment books, the relativity of valuation. Let's read this real quick. It says, I think a sensible investor has to take into account the characteristics of a business, the economic conditions, the investment environment, and valuations among different potential investments. Flexibility is the key and requires experience. Without real cash flow, good businesses are nothing but good concepts. That is what I think is really big. Without real cash flow, good businesses are nothing but good concepts. And what can we apply that to? The entire uranium space almost. And a lot of other areas like gold and silver junior mining companies. We are investing in what could be. We are not investing in what is. And there's a lot of risk between what is and what it could be. And then when people figure out what it is doesn't match what it could be, that's your problem. Most of it. It says, I quite often say to investors that despite being a value investor, I do invest in high PE stocks if the high PE is due to a passing business phase or a short-term mishap that is unlikely to reoccur. Another thing is you might see some of these commodity companies have high PEs at the bottom of the market, and then they get lower PEs at the top when they make all their money. Commodity companies are 100% subjected to the commodity price, which is the most important thing, is the commodity price to commodity companies. That is by far the most important thing. It says, while emerging countries have higher growth, they also have greater risk in terms of politics, corporate governance, the shorter business cycle, and less liquidity. And we are playing with some of these companies in other countries and emerging countries. Just an FYI. Coming down, we've got Med Faber. Smart money is just dumb money that's been through a crash. I like the quote. Howard Marks' checklist for finding bargains. We can look at that, but I'll read the bullet points here. Little known and not fully understood companies, fundamentally questionable on the surface, might require more digging, controversial, unseemingly or scary, deemed inappropriate for respectable portfolios, unappreciated, unpopular, and unloved. That's where I generally go. Trailing a record of poor returns, and that could be your cycles. We're looking for underappreciated, unpopular, and unloved, which also accompanies generally a record of poor returns for a decade. Then you get really low entry points. Recently the subject of disinvestment, not accumulation. And there is some of that going on for companies that have pullbacks. So to boil it all down in just one sentence, I'd say the necessary condition for the existence of bargains is that perception has to be considerably worse than reality. That's what it is. So coming down to Christine, she says European gas inventories seem to be drawing early but for the most part, temperatures are on trend. So temperatures are on trend, but we are drawing more and more because of that increased demand. It's going to get interesting here, boys. It's going to get interesting. Freight futures, AM update. Dry bulk, Capesize is down 3%, Panamax down 1%, and tankers are down a little bit. VLCC, which is the big boys, 1%, Suezmax down 2%. AECO's been ripping higher. That's natural gas in Canada, the Alberta natural gas price. So we went from 75 cents to 250 in a heartbeat. We'll see how that works going forward. Breakwave says during the first 10 months, Brazil's iron ore exports reached 325 million tons, a 6% increase year over year. That's looking pretty strong there for iron ore exports. Looking pretty good. Investment wisdom. The goal of investment is to find situations where it is safe not to diversify. That's the situation we're looking for. Charlie Munger. Peter Lynch says you only need 1 or 2 good stocks a decade. You don't need a lot of action. Says Peter Lynch. All you need. If you're not trading in and out and you can buy these things at real cheap prices and you find something where you don't need to diversify, you find a few good stocks, maybe it's a handful, perfect. Occidental CEO warns U.S. is at risk of losing energy independence. I kind of wanted to dive into the thing. So here is this, and let's read Vicky Hollob's CEO of Occidental, some of her opinions here. So she says it's U.S. energy independence is risk of slipping away if shale output plateaus and begins to decline. So this is her quote. It's going to start to roll over. And when that happens, that's when the U.S. is at risk for losing our energy independence. She goes on to say, that could come in the next 5 years that we start to see that plateauing happen. Let's go another couple of quotes. She says, Donald Trump, understands that if you lose all of your energy independence geopolitically, we would be weaker in that kind of scenario than we are today. What he wants us to get the most out of the reservoirs that we have here in the U.S. She goes on to say, Permian crude output will peak at slightly above 7 million barrels a day at the end of this decade, said Pete Bowden. He says, but thereafter will decline more gradually than most experts expect. So what he says is there's anywhere from 10 to 25 years of drilling inventory left in the Permian's Delaware Subbasin, according to a presentation. So there's 2 things here. Vicky says or expects that we are going to peak within 5 years, which is a plateau. There's obviously a bunch more drilling left but that means that we're halfway through the drilling. So we still have a bunch more drilling to do, but we're not going to produce at higher flow rates, is what she's saying. Warren Buffett says we don't buy and sell stocks based upon what other people think the stock market is going to do. I never have an opinion, but rather upon what we think the company is going to do. Sounds smart. Captain Forsyth says the divergence between gold and oil is unsustainable. That's creating that gigantic cheapness in oil, the big ratio divergence. And that's where I think the opportunity in oil is at. That's what I think. Coin just catching up. Well, here, 1 second, guys. Just check some. Okay, yeah. Bitcoin just catching up, triggering charts aside. Yes, post your comments. It is indicative of a wider speculative mood, bullishness, euphoria, optimism. The speculative mood, Bitcoin and NASDAQ moving together quite similarly. Fractals roughly the same. And that's what we've got for today, guys. So I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We've got that Black Friday coupon code going on. We've got a question and answer session happening on Saturday, which is going to be today at 7 a.m. Mountain Time. They are recorded. They are uploaded to the website if you can't attend. All right, guys. We'll catch you next time. This is Finding Value.